following is a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
That's right, you're Guy Allard. How you doing, Guy?
I'm doing great. How about yourself? You ready to go?
I'm ready.
Cowboys been practicing all week at the facility?
Oh, yeah.
No place to park?
It still shocks me. Like I said, we're, for those of you new to the show, whatever, our headquarters at the Star in Frisco, where the Dallas Cowboys headquarters are. And they're in the middle of training camp. And, like 10,000 people a day coming to watch their training camp. And we're used to not having many people around here because they were in, either off season or over in California. So you might want to, if you're coming to our office, you might want to pick a week other than this week. It's already over, but next week and after that, it's going to calm down quite a bit. Remember our philosophy here at McClure Capital. It has always and will always be the same. A lot of the so-called experts all agreeing with us now after all these decades, but we believe you should, whatever your monthly bills are, you should have a predictable income stream that pays them. Have it guaranteed. No matter what happens, your bills are always paid no matter what happens to the stock market, no matter what happens to interest rates. All right? And certain things are really good for producing income, predictable, reliable, guaranteed income, and some things aren't. Your dividend stocks and all that are good sources of income, but you can't count on them. They can stop the dividend, lower the dividend, whenever they want.
I think most of the experts, quote unquote, have always agreed that it's a good idea to get your bills taken
hard
care
expenses.
of. Absolutely. The economic Nobel Prize winners and all of that would all agree with that. I think the ones that disagree, or if there's any disagreements, it's how you come up with that income. And Victor and I have spent hours talking on the radio weekend after weekend about using a fluctuating asset like a stock market asset to provide that income for you. Now, if everything goes great, it'll work. But if it fluctuates, it doesn't work.
That's why we have the stock market is a great tool. Nothing's beaten inflation long-term better than the stock market. It's just not designed to pay your bills. So what you do is you have your bills paid with a certain portion of your portfolio. The other portion you can have, obviously, your reserve account, and then you've got your stocks for helping you beat inflation in the future, because there's no way your bills are going to stay the same 20 years from now.
And put that in perspective, let's look at the other side of that. Would you use a fixed income investment, a CD, a bond, or an annuity as an inflation hedge, or to grow your portfolio long term? It could grow it, but it's not going to work like the stock market.
And that's why
for that case.
All the people out there say that you should put everything in the stock market at all times are not looking out for you. They're basically trying to sell you something. You can't have all your money in the stock market unless your bills are paid. Let's say you've got a pension that more than pays your bills. You had Social Security, all that, then have at it. But most of us have to use part of our portfolio to help pay the monthly expenses. For those people, anybody that tells you to put all your money in my managed program or this stock program, regardless of your income, because we'll get it one way or the other, they're not looking out for you. I can show you mathematically how it can't work. It never works. Everything works short term.
The great news is the market has done so well now for so long. We're in our 9th year? For sure, 8th, possibly 9th year. Your accounts, as long as you haven't been paying too much in fees, and as long as your advisor has you in the right stuff, has probably doubled or better. So you've got enough that you've been able to make the last 8 or 9 years that you can peel some off, take care of your income, and still play the market.
The last couple of weeks we've talked about what to do at the market piece. That's not your fixed income piece. It's not producing your retirement income. Today we're going to talk about the different ways you can produce a steadable, predictable stream of income. Okay, so we're going to talk about all the different ones: the bonds, the annuities, the mortgage bonds versus government bonds versus muni bonds,
corporate bonds,
all of these different things. What type of bonds do they have? Like your subcategories of these bonds, And what we think this will help is because you can choose anything you want that's designed specifically to produce income. A CD is specifically designed to produce income. It's just not paying anything.
And obviously, when you go through the selection process, like a car or a home or your wife or your husband, right, you want to get the very best that you can get. Yeah. And what's going to get you the most income without risk, etc. Right.
So that's what we're doing now. We're going to concentrate on today, fixed income. Fixed income are your so-called safer investments. Now, in the old days, when you're doing a portfolio, when you're allocating a portfolio, let's say you're 50-50, which is 50% fixed income, 50% equities, which is stocks. And the stocks and bonds hedged each other, okay? So if your stocks are going down, your bonds are still producing a pretty good income stream for you. The problem we have now is stock market's at an 8 or 9 year high, okay? It's overvalued by a minimum 40%. The PE ratio alone. It's overvalued no matter which metric you use. So that's obviously there's some risk in that. Now, when is it going to go down? I have no idea. I wouldn't be on the radio like I've told you a million times. I'd be in Tahiti with one of my mini yachts with native girls feeding me grapes. I have no idea when it's going to go down. But I can tell you that right now it's different. So we have risk on stocks. We know that. But the fixed income risk is the part that a lot of people are not aware of. You've heard that old deal. Interest rates and bonds work opposite of each other.
Inverse relationship.
That's right. Interest rates go up, bonds go down. And somebody asked me, why is that? Well, let's say I've got a 3% bond. Interest rates are going up, so the new bonds are paying 4%. Well, who wants your 4% bond when I can get your 3% old bond when I can get a 4% new one? Nobody, unless the price comes down. And the one thing people don't realize when they're looking at bonds, and bond funds, by the way, those prices are just an estimate. There are 1,000 times, maybe more than that, more bonds than there are stocks. Thousands of times more. They're not priced that way. You've got to find a seller. It's not like brokerage firms act as a buyer and seller, right? So they'll buy it from you at the price.
Market makers.
And you got the price.
Yep.
Not with a bond. Whenever you've got a bond portfolio and it says it's worth $2 million, it's plus or minus 20%. More on the minus side, because you try to sell a bond when bonds are going down is almost impossible without really cutting the price.
As we always said, if you hold it to term 10 years, 30 years, whatever the case is, you'll get that interest rate.
That's right.
And you'll get your principal back. That's for sure. But if you have to sell it before 30 years, and that's a long time, then you're subject to either selling it at a discount or perhaps in the reverse deal, a premium if rates have gone down.
We've got interest rate risk since they're starting to raise interest rates at the Fed, right?
Yep.
What have they done it twice this year?
They were talking earlier this week about trying to do some bookkeeping with all the stuff they've got on from the quantitative easing.
Get rid of the bonds. Yeah.
That's right.
So that's what they've got. So interest rates are going up, therefore bonds can go down. That is one part of the risk pile in bonds right now. The other part is this. Unless you have really highly rated bonds, bonds can default exponentially if interest rates go up. Think about it theoretically. If I own a bond, let's say a bond is just a loan. A corporate bond is you're loaning money to a corporation. A government bond is you're loaning money to the U.S. government. All right? So you're loaning money to them, and they're paying, say, 3%. Okay? What if interest rates go up to 4%? Well, I can't, and I'm the bond guy, right? I'm paying you 3%. Well, obviously, I can't afford 4% if I can't afford 3%. So when municipalities get in trouble, governments get in trouble, corporations get in trouble, you'll start having defaults on bonds that shouldn't default normally. Bonds have been in a bull market, which means interest rates going down for 30 years.
Long time.
So people forget 2 years ago, much less 30 years ago. So we forgot all that. People are buying high yield bonds, which is another term for junk bonds, Absolutely. At record numbers right now.
Yep.
And those are the riskiest bonds in the world. And plus they want the highest yield, so they're going with the longest bonds. In other words, I'm going 20 years out, 30
risky
years out.
and long.
That's right. Those are extremely risky because the lower rated the bond, the worse risk there is. The longer it is, the worse risk there is. The more you have take a huge loss if you get out of it. So,
And more margin, when you talk about a 20% plus or minus, there's usually more margin in there, too, in those long,
right.
risky bonds.
So my point of bonds are a stock and bond portfolio, a standard everyday stock and bond portfolio, has double risk now when it does it normally. So you have risk on the stock side, that's obvious. But there's also the default risk and the interest rate risk of the other side. Now, on your fixed income portion, how to prevent that if you love bonds? Well, you're going to have to go ultra short bonds. Short bonds with a high grade. In other words, like AAA short bonds. Those won't have much risk, even if interest rates go up, because they're about to mature.
And they don't pay a lot either.
That's right. They're not going to pay a lot, but that's where you do. Or a CD or a fixed annuity that doesn't have interest rate risk is another option. We got a break coming up, folks. Today we're talking about fixed income. Remember, if you have any questions, anything about your portfolio, or like to take advantage of any of our services like a complimentary retirement plan, Social Security Optimizer, our number is 972-715-2424. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions, we're here to answer them. 972-715-2424. Oh, I wanted to make sure. Somebody got mad at us a couple weeks ago.
Uh-oh, what'd we do?
Our family is very important to us. So we're not answering the phone on the weekends. You leave a message, and we'll call you back first thing Monday. So again, 972.
Did it happen again?
No, 715-2424. We took live call-ins for years.
Yeah.
But it was too much. So we love to answer your questions, but like I said, we'll call you Monday. 972-715-2424. Today we're talking about bonds, fixed income. We're talking about fixed income in general, and now we're on to the bonds. Bonds are just debts.
As a method to take care of your bills.
That's right. Remember, our philosophy is get your bills paid by consistent, repeatable, guaranteed income. And then the stock market is a fantastic place to fight inflation and your liquidity needs and all that.
Right. And at the risk of being redundant, just to kind of give you a snapshot, if no matter what your fixed income security is that you're doing, bonds, annuities, money market, CDs, if you're making 4% and you've got $1 million and you need $40,000 a year, you can take $40,000 a year and you'll still have your $1 million. We talked in the first segment about not being able to have the same success with a fluctuating asset. And to use the same example we've used for a while, if you had $1 million in the market since 2000, right? 16 full years, and the market has compounded a little over 4% a year. You can't take 4% out and still have $1 million. The absolute numbers, and you know where about the numbers are, if you would have taken 4% or $40,000 a year off of that $1 million you had in the market since 2000, right now you'd have about $600,000 left.
And you haven't had a down year in 8.5 years.
And yeah, it's been a great market.
As soon as one down year happens, it's a lot worse. And so think about the reason why you can't take all your income or your bills from a stock portfolio is every time you need bills, you got to sell some of those stocks.
Whether they're up or down.
Whether up or down. And if they get down 50% and you got to sell to pay your bills that year or that month or whatever, it puts you into a death spiral. I could show you the mathematics. Anybody has you can prove it 1,000 different ways, even though there are so many people out there saying, no, my stock and bond portfolio will pay your bills. That's the only thing you should have. Anytime anybody tells you there's only one thing you should have, which is my managed program or my annuity, whatever, they're not advisors. They're just selling you whatever their program is.
And to take it a step further, be careful if they tell you their program is average, because you just heard us talk about the last 17 years, the market's compounded rate with dividends without any fees.
That's not a penny in fees.
Yeah, it's 4% a year, a little over 4.
4.06.
But it averaged 6.
That's right.
50% better.
Because when you take an average of all your returns and divide by the number of years, you're assuming a static principal, which we know you can't have a static principal in the stock market.
That's right.
You can have it. See, that's why I said bonds, fixed annuities, bonds, CDs, much better for paying your bills.
That's right.
You're going to get the income, and your principal is always static. That is important. It's hard to explain. If you know anything about math, it's I can show you in a second. Call us and I'll be more than happy. 972-715-2424. But now all of the Harvard, everybody that's won the Nobel Prize for Economics agrees with this. The only people that don't agree are selling some managed stock program and say their mother would rather die than go to.
And the problem is
whatever,
they're not spending $1
buying
million a month advertising to you that you should do this.
That's right. So, but it makes sense. Okay, so let's talk about the different kinds of bonds. The ones that are considered the safest in the world, some people might argue.
GO?
No, just the normal U.S. government bonds. Government bonds, treasury bonds. You got treasury bills, treasury notes, treasury bonds. Bonds are usually the longer one. They got rid of the 30-year for a long time, but they brought it back. The problem right now with government bonds are the yield curve is flat. 5, 10-year bonds are the same as 30-year bonds. They're pretty close.
Yeah. So why
am I going to go out that far, right?
That's right?
So I'd recommend a shorter bond now. What happens is with the different government bonds and municipal bonds, one is they're both tax-free to some extent, right? Government bonds, they did an agreement years ago that said, all right, we can't tax our own bonds. So government bonds are their federal income tax you got to pay, but the state income tax you do not.
That's right.
With the municipal bond, you still have to pay state income tax, but you don't have to pay federal. But you have states like Texas, which is double tax-free. So be careful when you're buying bonds. You want to make sure you buy them from a tax-free state.
And then you've always got the alternative minimum tax, which is AMT, which
right.
you can get stuck for when you think you're getting something tax-free.
Right. We'll go into that more when we go into muni bonds.
There's a few hurdles.
With government bonds, like I said, you got the shorter ones, T-bills, the medium ones, T-notes, and the longer ones, T-bonds, treasury bonds. Those are very safe, held to maturity, considered the safest thing in the world. Like I said, it's arguable. Some people don't believe the government's that safe with the deficit and all that, and they're just printing money and it's fake anyway. But
they're buying gold, right?
Then you've got municipal bonds. Municipal bonds are how they build stuff in a municipality, like Prosper where I live or Frisco or whatever. You'd think the tax money would pay all that, but really, tax money is not the big infrastructure projects. It's more just to keep the thing going, paying the cops and the teachers and blah, 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 blah. And then bonds are rated differently. If a school district is a very wealthy school district, big tax revenue, it's going to be rated, AAA on its own. Sometimes they have to buy insurance to get an A rating or a AAA rating.
Yep. The
problem with those are when we had this crisis in mortgages and everything back in 07, 08, half of the insurance companies that insure municipals almost went under.
Well, and the rating companies weren't giving correct ratings either. I believe it was
right.
Standard & Poor's.
We got a break coming up. Remember, if you have any questions, don't hesitate to call us at 972-715-2424. If you'd like to take advantage of our no-cost, no-obligation retirement plan, Social Security Optimizer, or just like an information kit, our number 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome, welcome. Remember, for those of you listening, Guy is old and I'm experienced. We're not just like...
And this is important. Why?
We've known each other a long time. We're actually about the same age.
Although you couldn't tell it by looking at us, I'm just saying.
Today we're talking about fixed income. Fixed income is a very important part of your portfolio. I understand some of you out there say, well, I got there this way. Stocks, it's all stocks. I love stocks. We've been managing stocks for 30 years. We love them.
Come talk to us about them. We got some great programs.
And if you're going to retire, they're one of the worst things to pay your bills with is a stock account.
But I will mention right now, since you opened the door, Victor, if your stock accounts haven't done just fantastic in the last 8 years, please call us. You're paying too much in fees, or you may be in the wrong things, or you may have some overlap if you're all in funds. There's all sorts of ways that we can execute some things to make those more efficient for you as well.
I know we told you that the market has made, which 90% of people do not beat the overall market. 90% of money managers don't. 4.06 with right. Dividends, compounded for the last 17 years. If I ask 20 people in a room, because we all think short term, we're not thinking, what has the market made this century? 90% of them would say 8 to 12%.
That's what they're used to hearing.
Yeah, and it's 4.
And in fairness now, since 2000 we've had 2 corrections,
That's right.
which has brought the return down, but it's a 17-year window.
The average person during this period has made 2% a year. What happens is when you're doing 401ks and they're growing, especially like lately, the last 7-8 years, they're growing that, and you're adding money in, it's hard to think like, no way, I've made much more than
good.
2.
Yep.
Well, you probably have, but you might have been putting in 4 a year in principle, like in your 401k contributions and matches and all that. All right. So we're talking about fixed income, the thing that's supposed to pay your bills. It used to be the old days, just CDs. You know, I'm going to save $1 million. I'm going to put a 10% CD that's going to pay my deal. I'll be a millionaire forever.
No risk. My grandfather, CDs, that's all he would do.
And they'll still work, except they don't pay anything. Your bills have to be what, $10,000 a year, maybe 20. You were going to say something, guy. I'm sorry.
No, we're
Okay.
good.
All right.
I was going to mention, we were talking about stocks. I hate to regress, but a lot of you may be captive in a 401k or something and feel that you really can't do much. But we've helped a lot of people with their existing 401ks. And then as the time comes, we can do some other things. But we're more than happy to help you kind of go through your selections, clean that up a little bit, get rid of redundancies. A lot of nice things we can do to help you with your existing 401k if you're interested.
And don't forget, if you're over 59 and a half, you still plan on working for several more years, you still have access to your 401k. That was the Supreme Court ruled several years ago that you can sue your employer for lack of choices.
No one wants to do that.
No. As soon as they did that ruling came out, all the trustees, the 401k trustees said, let them out at 59 and a half.
Yeah.
The money becomes liquid at that point. I'm not suggesting closing out your 401k. You still want to keep contributing. You still want to get your matches. What I'm saying is you can take a part of that corpus there and do something with it if you're going to set up for income or whatever, and you just have a lot more choices. That's not always the best way, but a lot of the time it is.
Yep. So
you have to look at your situation. We're experts at looking at that, saying, all right, is it better to keep it in the 401k or better to do something with it? And if you want us to look at it, no problem, 972-715-2424 or go to ilovemyretirement.com. All right, fixed income. We're in the middle of municipal bonds. Well, we did government bond first. Now we're doing municipal bonds. Municipal bonds are, like I said, municipalities. That's how they fund their projects, their infrastructure projects. The good thing, municipal bonds are federally tax-free, state taxable. We just don't have a state tax here. So municipal bonds are pretty good. So they'd be 100% double tax-free for us, right?
Right.
You just got to go out a long way to get a decent rate. You can get 3 or 4% on some decent ones. You go out 30 years. And if you won what's that guy in Massachusetts won the $750
I never heard the
lottery?
name, but he won a lot of money.
You won, a man or a woman, I don't know. But
didn't you say
you can live on 3 or 4% tax free? I'm pretty sure.
Did you say winning that was like flipping a quarter and getting heads 500,000 times
like
in a row?
Something like that.
Holy cow!
Then I always say, well, I'm wasting my $1 or $2 every time because I'll still buy them. Still got to have the dream, right? You're buying a dream.
That's right.
That's all it is. Muni bonds, there's 2 types of municipal bonds. There's general obligation bonds and revenue bonds.
Revenue bonds.
If they're going to build a stadium or a bridge with a toll on it or something, that's a revenue bond. If the revenue thing works, you get paid back. If it doesn't, you might not. A GO bond with the full taxing authority of that municipality. In other words, they can raise values. They don't do that without them really going up, right? They can raise the tax rate. So a general obligation bond is the one. If you're buying municipal bonds, I don't know if I don't like the ones that have the insurance right now because I was a little snake bit in 08. Just buy one with the underlying municipality is a AAA. And a lot of the wealthy suburbs around Dallas are. And those are really safe bonds. We got a break coming up, folks. We'll talk more about fixed income when we return. Don't hesitate to call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Okay, we were talking about bonds today. Welcome back to the show, by the way. We talked about government bonds, municipal bonds. Let's talk about corporate bonds. Corporate bonds. Remember, you got investment grade. That's triple B plus or triple B and better. Then you've got high yield bonds. They used to be called junk bonds.
What Vegas was built on, baby.
That's right. It's amazing to me that high yield sounds great. Yeah, heck yeah, I want something
I
that's
want
high
some
yield.
of those, yeah.
It's the same thing as junk bond. It's the exact same thing.
Yeah.
It's a lower than triple, and it's amazing if there's 20 ratings of bonds. It's just all the way up. Triple B and better is investment grade. Those right there have a default rate like under 1%. If you just drop one down, so the best of the high yield, I think it's like 8% or 15%. It jumps a human.
And to give you just a small glimpse into things from our side of the desk, if you will, if we can't even sell something that is not investment grade, or our insurance doesn't even cover us.
That's right. That's right.
They won't cover us unless it's triple B or better.
That's right. And so people buying these high yield bonds and buying longer ones, or they'll buy a high yield bond fund, they don't realize it's 75% long-term junk bonds. Because when you're looking for the best yield, it's just like a person. If you've got terrible credit, no money in the bank, you could still get a house. You're just going to pay 7% when everybody else is paying 3%.
It's like buying that 2-year-old Cadillac for $5,000 instead of $25,000. Then you find out the title's a reconstructed car.
Right. Junk bonds, high yield bonds are very dangerous right now. And think about it. It's a company with bad credit. So you're just anytime you buy a bond, you're loaning somebody money. You're loaning the government money. You're loaning a municipality money. You're loaning a corporation money. So why would you loan your cousin that's never paid a bill in his life a bunch of money? No. But you'll loan it on a high yield bond all day long.
It's a gift.
Yeah, it's the exact same thing. So be very careful. Now, does that mean junk bonds should never be in a portfolio? No, I didn't say that. It's okay to have a small portion in something like that to increase your yield, especially if interest rates aren't going up like they are now. If they're not going up and expected to stay flat for a while, it's okay having a little bit of junk bonds because they're much safer at that point. Right now, I think they're extremely risky. Anything that has bad credit, you don't loan it money unless they're paying a whole bunch for it, right?
The name of the show, Common Sense Investing. Give it the common sense test. If money is available out there for 2 and 3%, and someone's offering you 5, 6, or 7% for money, there's a reason.
It's not an opportunity. It is now suspect.
That's right.
That's what I got to go. I had a guy that called me from the radio. He listened to the radio show for many, many years. He said, you don't understand. There's this place in Seattle, I think, that's paying 8%, been in business 40 years. And they've never, ever missed a payment. I've been with them 15 years myself. And all I asked him was, I go, okay, think about this. At that time, my interest rate was like 5. Why would somebody be paying 8 when they could get it for 5? Well, they've told me because it's the cost and it's direct to the consumer. Direct to a bank is cheaper than direct to a consumer.
Yep.
Because you're not having to sell things, hire a salesman or anything. And so that didn't make sense. And obviously the moral of the story is he called me within months. All the money's gone. Private investments are way worse than public. We're talking about junk versus this. Usually a private investment is below junk. They cannot get money from a bank at all. So you got to be careful. Be very careful with corporate bonds.
Think about the risk involved with regulated securities and investments. There's not a guarantee, right? Or we'd all be billionaires in a matter of 3 or 4 years. There's always risk involved, but that's okay. We weigh and we balance the risk and we accept it based on their rating and all of that. Take all of that away, and how much risk is there?
It's amazing to me, all these people that are investing now in these private real estate partnerships. Because real estate's doing great.
And they get good payments, 6, 7, 8%
sure.
for a while.
But 10% some of them.
Yep.
But you don't realize if that developer could do it for half the price or less, because why can't you get a loan on a piece of real estate? You could easily do it, right?
Yep.
They have no financials. There's nothing financial backing this stuff up.
Oh, but it's a big corporation.
Yeah, I don't care if it's been in business 1,000 years. Why are they paying 10% when they could get it for 3 or 4?
There's a question.
That's what you always got to ask yourself. Remember, this is called the Common Sense Investing Show, and we talked about this years ago. If you put a common sense hat on almost anything, it will prevent you from making a lot of mistakes. And right there, thinking something in real estate's paying 10% is safe. I'm okay if they tell you it's risky. We think it will be fine because of this, this, and this, but it's risky.
And you'll
they
allocate
don't. They tell you it's safe.
That's right.
It's backed by safe New York real estate.
And we've got an exit strategy in 2 years to get all your money back.
I've been in real estate for 500 years, whatever. I don't care. Why are you paying 10 when you could get it 3, right? But it's just there's no financials, nothing back it. It's just a promise to pay. Remember, a government bond is promised to pay by the U.S. government. A corporate bond investment grade is promised to pay by a seasoned company with financials because they're investment grade. Junk, you start getting into not as good financials.
Yep.
Private investment, no financials.
And no market for your investment back.
That's right. No, nothing there. So these are investments. We're talking about what you pay your bills with, fixed income, reliable things. All of these do that. We're just telling you things to stay away from and things to look for. Right now, the only kind of bonds I'm interested in, especially with a flat yield curve, short-term bonds. They're not going to go down much if interest rates go up, and they're going to mature soon, so you can get the higher interest rates.
You're not committed to it long.
Right.
That's right.
The ones right now that are the most popular are probably fixed annuities. I know people say, "Oh no, not." It's the same. It's a fixed annuity. There's a CD type called a MYGA. Right now, you can get 3.1% for 5 years. Now, 3.1 for 5 years, and the best CD I know is about 2.25. If you do all that math, because one's tax deferred, annuity's tax deferred, judgment proof, avoids probate, you got to pay tax every year on a CD, and so the difference is the only thing earning that remaining couple percent. I just did analysis for a client this week, and it came out over 5 years, 42% more interest by doing the annuity versus the CD. Well, the rate was close. It wasn't exact, but it was close. But that's what you could do. That's why fixed annuity more popular. No interest rate risk, that kind of thing. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the Common Sense Investing Show. Today we're talking about fixed income. Remember our philosophy. When you retire, and you need to set up with this before you get to retirement, because it costs you about a fourth as much money if you'll do it early versus right at retirement.
Absolutely.
But fixed income, you need consistent, repeatable income to pay the bills. You do not want to have to sell a stock portfolio to make bills, especially into a declining market. Mathematically, it is horrible, and not one person that understands math would ever say do that, yet every person out there does, right? The only thing you should ever be is my managed program, or the stock annuities are the devil's work, blah, blah. They're not telling you the truth. Annuity is just a fixed income piece. It's just from an insurance company instead of a corporation or the government, right?
And the reason that we talk about fixed annuities so much, if I can interject, is right now it's a vehicle that gives you the very most income for the least amount of money. It's the biggest bang for the buck. And I got to correct a statement I made last week on the show. I gave credit to Abraham Lincoln for a saying, and it was actually, I looked it up this week, and it was a fellow Nazi by the last name of Goebbels, Goebbell, I think. And the saying was this: if you hear a lie often enough, it becomes the truth. And the reason I mentioned it that week and the reason I'm mentioning it this week is you have these people that want you to have all your money in their managed program all of the time. And they keep telling you that annuities are bad and the fees are at nosebleed level. And those are half-truths. You really need to look into it, so much so that when you show somebody a fixed annuity, and it really helps their portfolio by taking care of the income, which we talk about, and relieving that burden from your stock portfolio, it gives, on a $10 million portfolio, one instance, maybe $4 million more of assets in the account. But in the back of people's minds, because they hear all of this crap, if you will, on the internet and on TV that's not truth, it prevents people from doing the right thing sometimes.
Yeah, you just got to be careful. Just look at it. Always put a broad perspective on it. Like right now, 3.1% fixed annuity is better than that's tax-deferred, judgment-proof, avoid probate, is better than a 2% CD.
All day long.
A CD has $250,000 insurance. It's got like 10% reserves. So over 250, you know you're don't do it, right? Fixed annuities have similar kinds of insurance, but also 100% reserves. So it'd be kind of like buying a corporate bond where they put the money in an escrow account. So if something happens to them, you have access. It's not exactly an escrow because it is a general account, but it's still, no matter what they have for whatever their surrender values are, they have to have a minimum of 100% of that in reserves at all times. And those reserves have to be invested safely.
And we meet with people, a portion of the people we meet have their pensions taken care of. They don't need income. So we talk to them about managed programs and exchange traded funds. But I will tell you, from this side of the desk, the majority of people we meet have everything in stocks, and they don't have the income part taken care of, and that's why we spend so much time on this.
Remember, there's the accumulation phase of your life versus the distribution phase.
Yep.
You cannot manage your assets the exact same. I don't care how successful you've been, because we're creatures of habit. This is psychological. If I've been successful at something, why am I going to stop it? Because the distribution phase of your life is completely different. You mess up one time here, nobody's hiring an 88-year-old to work at a corporate and make that money you were making when you were 60. Right?
Not that we would want to, right?
Right. So that's what you got to be careful of, is messing up during the distribution phase. Have those bills paid every month till you die, and you don't worry about anything. You don't have to sell when the market's down. You don't have to make rash decisions. Your stuff is taken care of. We're just talking about different ways to produce that income. The last way we talked about government bonds, municipal bonds, CDs. CDs and money markets are easy. Everybody knows those. You're just going to get 1 or 2%. And if you can live on 1 or 2%, there's nothing wrong with a CD. I like getting a little more for my money, but there's nothing wrong with it. Don't ever go above the 250. Remember, you can do different pot accounts, payable on death accounts, to get multiple 250s even at the same bank. The last one we'll talk about is fixed index annuities. Fixed index annuities are still fixed. You can't lose any money. That's the common denominator with, as long as it doesn't default, but when you have 100% reserves, never heard of a default.
I was going to say, the reserves are second to none.
It's not like I think insurance companies are great people. I don't. I just got my renewal for my homeowners insurance. Yeah, I don't.
Yep.
Except they can't spend your money. It's 100% reserves on all their current liabilities, so it's very, very tough to lose on a fixed annuity. But a lot of people doing the index annuity side instead of the fixed, because 3.1 is pretty good for 5 years. I never thought I'd say that, but it is. But index annuities, you're getting up years of connected to some stock market index, no down years. You're not actually in the market. That's important, because you can't take any market risk. They actually buy bonds with your money, and they buy some index options. Options are leveraged as such, so you can get a good portion of the market up here. The market goes down, you can't take a loss. Those are really popular because I've got some of those now that we're talking about real returns, folks. 5 to 7%. Worst it's ever done is 5%. The best 7. Well, 5 to 7 on something safe isn't bad. The problem comes with the index annuity side. There's so many brokers selling them out there. They're giving you the BS with 18% bonuses and 20% bonuses. Those bonuses are a gimmick. Like the one right now that's offering 20% bonus, there's 30 other companies paying you more income. And that's what you want. It doesn't matter how they get to that income.
That's
It matters how much income is paid. So there's 20 or 30 that produce more income. Remember, if you have any questions about any fixed income products, annuities, bonds, anything, don't hesitate to call us, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. You can call us toll free, 1-800-McClure. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by McClure Capital Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.